Volume basics. We want you to radically improve your trading with volume analysis. Now, price action, that is the change in price, it gives us a clear picture of what has and is currently occurring regarding the value of any stock or ETF. Volume analysis is what we're going to talk about today, and that gives us insights into why price has been changing. In addition to that, it helps us discern the stability of price action and where it may be going in the future. And this is critically important. It's the other half of the equation. If you're just using price analysis, you're going to miss out on what else is really going on. Now, common sense tells us that volume and price should move in sync. That's probably why you might think, well, I don't really have to worry about volume because if price is going up or going down, then volume should be matching that. Well, that's not the way things actually work. When we start looking at volume, we can tell that it changes and strange anomalies occur, like here where we see two spinning tops, almost dojis, but average volume. Something sneaky is going on right there, and after they occur, you can see where price drops off. When we think of supply and demand, we think that when volume and price are out there in the marketplace, they should be reflective of each other. Increasing price action goes together with higher volume. Decreasing price action goes together with lower volume. My friends, that's just not always true. Matching movement between price and volume does not always occur. Why? I want you to hold on to your seats. The markets are subject to manipulation. That is exactly right. Large institutions, dark pools, market makers, and various insiders are many times at work, self-dealing and manipulating prices to their advantage. So it's been going on since the beginning. It's nothing new. It's no new sneakiness that has gotten into the system. This kind of stuff has occurred forever, and volume helps us see when it's happening. Small price moves, high volume. Many times volume action, when viewed in conjunction with price movement, can give you an idea as to what the insiders are doing. If there's small price movement but large volume action, like we showed you right here, well, my friends, there are potentially three things that are going on. Distribution accumulation is occurring, lack of buying or selling pressure is taking place, and indecision in the marketplace. One or all those could actually be occurring. Now, when we look at this chart here where we show volume on one side, low at the bottom, high at the top, and we show price change, the candle size, on the bottom, we can see that if you have low volume and you have low price change, that is a small candle, that's normal. If you have high volume and a large candle, that's normal. But where we start getting anomalies, and the first we'll talk about is here, where you have high volume, but not a big candle. Well, like I said, in an up market, this is distribution. The insiders are selling their stock. They're selling their ETFs, while the non-insiders are sitting there like dummies getting ready to watch the price go down. In a down market, they're accumulating. In fact, they've scared everybody out of the market. They're selling all their stocks or ETFs at a cut rate price, and the insiders are buying them. Now, also, it can be related to, like I said before, a lack of buying or selling pressure and indecision. We'll talk about this other anomaly with price discovery and possible exhaustion here in just a minute. Here's another way to look at it. That anomaly is potentially a trap. A potential reversal is sitting right there. And again, when it's moving the right way, it's just confirmation of the moves. Low volume, low price change, that's normal. High volume, high price change, that's normal. That's supply and demand working. Now, distribution and accumulation, let's talk about the first of those three. When price and volume have been moving up with green candles, top wicks, and matching volume levels, and then the candles change to spinning tops or dojis with high volume, this incongruity between price change and volume, that is, low price change, high volume, those are dojis, those are spinning tops. They can indicate a significant amount of selling, that is distribution, by large investors or insiders. Such action may be sending a bearish signal, that is the end of an up move is near. For example, those two spinning tops I showed you before. We had the market turn up and climbed. You can see where things peaked with this high volume and the highest high. And then you saw things go into a doji, two dojis in fact, and look at where the volume stayed. I mean, you can see these other candles. I mean, they were decent sized candles along the way. And then you have very little difference between the opening and the closing prices, and you had all of this movement up and down. Well, guess what the insiders are doing right there with this kind of volume? They are literally distributing all of their stocks to the suckers that think that the stock is going to keep going up, or ETF, I'll use those interchangeably. And then, of course, they try to peek it out once more, and then it rolls over and heads down. That's what I am talking about there. Now, conversely, if the price has been moving down with red down candles, bottom wicks, and matching volume. Now, again, we can see here where price is going down. That's what I'm talking about here. And then the candles change to spinning tops and dojis with high volume. This incongruity, the complete opposite of what we saw before between price and volume, low price change, high volume, again on the downside, can indicate significant amount of buying activity, that is accumulation by large investors or insiders. Such action can be sending a bullish signal that the end of a down move is near. Does that make sense? We see where things are going down, and then we get to two dojis, and look, we can see that very little price movement between the opening and the close on these dojis. But again, look at the volume here, and then all of a sudden things turn around and head back. What's happening here? Well, the market makers, the insiders, are buying all the stocks up for cheap at the bottom, testing the bottom there, and then moving things up. So that's the way that works. Being forewarned is being forearmed. Now, lack of buying or selling pressure. When you observe high trading volume with minimum price change, that is small candle size, in a market that's been moving up or down, you may be observing insufficient pressure to move the market. This lack of pressure could be revealing insiders and or market makers at work trying to test the market's willingness to accept a price increase or drop, depending on whether it's green up candles or red down candles, and they're finding no acceptance. Be careful and look for a breakout or a breakdown in price. This is where we see things going into a breakout. So again, pay attention when you start seeing high volume and very little change in price. Something is going on. If it's at the bottom, it's accumulation. They're buying the stocks. They're accumulating the stocks and ETFs cheap and getting ready to sell them, or they are selling them and depleting their warehouses of all their goods so it can go down. Think of it that way. Now, indecision, that's another possibility. High volume with minimal price change can be indicative of indecision in the market. This means buyers and sellers are equal and there's no clear direction for the future of price movement. If that is the case, then of course you just hang on and wait for the signal, that is price and volume changes that show you the direction the market is going to go. Maybe it has just moved up for a while and it's digesting some gains or digesting some losses if it's going down, and it's going to keep going in that same direction. Sometimes what you're seeing there is indecision. Most of the time, though, you're seeing the market makers in there making things happen. Either they are distributing at the top or accumulating at the bottom. Now let's talk about this. This is large price moves and low volume. This is the opposite. Low volume levels and large price moves are signs of possible illiquidity, but most often this discrepancy reflects actions by the market makers and insiders. These parties are engaged in what's called price discovery. In other words, they're manipulating price up and down to see if the current trend has been exhausted. That is, they've exhausted all buying in an up market or selling in a down market. Now, to go back to this earlier little chart I showed you, that is what we see here in this quadrant. We see large price change, but not a lot of volume. Now, again, that is a weak market in either direction, either a potential top or a potential bottom. This other chart, you can see the anomaly, price discovery, and possible exhaustion of either an up move or a down move. Now, the opposite is possible, like I was just saying, in a down market. If you see a long down wick below a previous low with little volume and no price follow through in the next candles, then the down move itself may be over. And of course, the opposite in an up market. Let's look at an up market first. You can see where prices come down, you have hit a lower low and then it pops up, and then things start to move up. Now they move up over the course of a few weeks, and then they hit a high. Volume is low. After that, things change and then start to move down. That is where the insiders were trying to push that price up to see if anybody would jump, and when they did not go above those prior and then the subsequent highs, what happened? Things rolled over. The opposite is true when you see down moves coming to an end. A market trending down, you have a low here on decent volume, then volume drops off, pegs down, then back up, volume increases, but again, nobody's bought into this lower low. And then, of course, things turn around and start to head up. That is the way that works. Now, the bottom line, if price and volume do not match, my friends, then you need to do what? You need to investigate. Generally, they should go together. This statement means that a large candle should have higher volume. Accordingly, a small candle should have lower volume. Now, to help you, we always add onto our charts a 20-period moving average on the volume. So it shows you over the last 20 periods, if you're on a weekly chart, a 2-day or a half-day chart, again, it's just the 20-period moving average. Now, you can adjust that if you want. 20 is a good number. And what it does is it helps you see the average volume on the 20 periods before that. What that allows you to do is just have a feel for what the average volume is. Also, I would encourage you to compare any candle and its volume to other candles and their volumes around it. These comparisons will allow you to obtain a feel for reasonable price movement and volume size. Now, when volume doesn't correspond to price, something is amiss. And as you spend time practice trading, you'll gain more and more prowess when you read the charts and the volume fluctuations. And again, with just the general charts, you're going to get general knowledge as to how those apply. With your favorite and most often traded charts, you're going to get particular information that you can use going forward. Remember, 10 to 15 minutes each and every day. That is all we ask of you. Stay with us. More trainings to come. We always love to hear from you. cw@chartingwealth.com is the way to always get up with me. God bless, my friends. All the best from the whole team at Charting Wealth World Headquarters.